On SMSFs, the government banned, what did they ban?
Taking a loan to purchase residential property.
They didn't touch commercial property.
Didn't touch commercial.
Yeah. Why didn't they touch commercial?
That's a very good point.
Because they went after everything else.
I think predominantly the narrative is to try and take the heat out of the residential loan, right? So they want to house prices, first home buyers, etc. That's all of the media. How do we get more people buying their own home? They figured they would try to limit SMSFs buying residential property to try and assist that. I don't think that's going to work, to be frank. That's really the reason why they've done it. So people aren't going to live in a commercial property, so it's not really part of the picture.
Okay, so commercial property, warehouses, offices, factories, retail shops, all that stuff, right? Anything except for a house, pretty much.
Yeah.
Now, this is interesting, and not everyone knows this. If you own a business and the business needs a premises, you can set up your own self-managed super fund or do it with a few other people. You can buy a business premises and your business can lease the property. So why would someone want to do this? Like, what are the benefits?
Well, the benefit is
Welcome back to the Winners Playbook. I'm Billy Norman, and today I've got Steve Sloane here in the studio. We are doing 5 rounds of money myths. Is financial advice actually too expensive, or does that just sound true? Number 2, should young people be putting less into super, not more? Is rent vesting dead, or does it still work if you do it right? Should you buy your business premises through your self-managed super fund? And then the last one, and this is a big one for business owners, is it right to ignore super and think that your ownership in the business is your super? Let's get into it. Steve, welcome to the podcast.
good to be here, Billy.
Before we kick off, so we've got 5 topics to go through here, but we've just found out we've got 4 advisors nominated for this FS Power 50. So it's like the 50 most influential advisors in Australia. So if anyone who listens to the podcast and enjoys our content, they can vote for us.
Fantastic. It's a great achievement for the group, and to have 4 nominations is spectacular, and just a testament to the hard work that our advisors put in.
That's it. And I was saying to the team, because the staff here, it'll be a tough choice for them, right? They're going to choose between 4 of us.
Yeah.
I don't know if they'll choose you because you're the boss, or maybe not. Right? So
probably not.
But I saw you can actually pick multiple people. So if there's a few advisors you're a fan of, or you watch their content or whatever, you can pick a few. It's pretty easy to do. You just put in your name and click go. So
yeah, fantastic.
All right, well, let's jump into it. So first topic here, on the topic of financial advice, everyone's got an opinion on whether advice is actually worth it. And obviously a lot of people with those opinions haven't actually engaged in advice. They've just sort of seen the cost and gone, it sounds way too expensive. So before I throw to you, just a couple of numbers here. The median cost of ongoing financial advice in Australia is nearly $5,000 a year. Mm-hmm. That's gone up 58% in the last 5 years, driven by compliance costs, but like everything's gone up in price, obviously. Like running a business has become really expensive. And there's this consumer survey here done by Advisor Ratings, and it says only about 6% of Australians say they're prepared to pay current market rates for advice. Yet, the people who do work with an advisor enjoy a higher quality of life. In this survey, 9 in 10 people with advisors feel like they're financially secure and financially better off. The other thing, which you would know a lot about, speaking to a lot of other advisors and business owners, is most practices are at capacity, growing, whatever. So although most people say it's too expensive, the reality is advisors are flat out. So do you think the affordability criticism is fair, or is it just like a perception?
Yeah, good point. Look, it is a perception, I feel, because once people get engaged in the process, then they get on board. But I also understand it is not cheap. Our services are not cheap. We've trained many years to be able to give this advice, and we're paid for like professionals. However, consumers have a way to pay that can absorb a lot of that cash flow impact through a bit from superannuation and a bit from their bank and investments accounts, etc. So advisors generally can work out ways for clients to absorb that costs for them. But absolutely, as you said, advisors are at capacity, and there's a lot of work coming through. And our retention rates for clients is extremely high, which shows that once people are on board, they stay on board.
Yes, and the other thing I've seen is like, especially because we get a lot of clients through social media, sometimes they'll come through, have a chat, they'll hear what it costs, and they'll be like, oh, it's way too expensive.
Yeah.
Then they'll come back like a year later.
Yeah.
Hey, Billy, just remind me what it costs again. I tell them, oh, okay, yeah, we'll think about it.
Yeah.
Sometimes it takes 2 or 3 years, and eventually they go, I just need this.
So they need help.
And then, as you say, once they're in the system, they're like, okay, this is obviously worth it. I'm not going back to DIY now.
No, that's right. Look, I think once people realize how much time it takes if they want to try and do it themselves and try to work out themselves and the research and everything goes on behind the scenes, I think then people realize, hang on a minute, this is the reason why it costs a bit of money, because it takes a long time to provide advice, and good advice for that matter. And I think, I've had a number of clients in that aspect that they've done exactly that. And then 2-3 years later, they go, you know what, I just need to get involved now and pay. So.
Yeah, that's it. And we got a little win from the tax office, which I don't know if anyone's ever said that, but we did get a win. They confirmed that some of the advice costs are tax deductible, the upfront costs, recently, which helps as well. And then, as you say, you can pay through super.
Yep.
And this is a question. What's, like, if you're trying to figure out the value, what is the cost of one poor decision?
Can be dire, to be honest, especially with tax. So, prime example, if you're buying an asset and you buy it in the wrong tax structure, that could mean tens of thousands, if not hundreds of thousands of dollars of mistakes over the course of the journey. So, that's simple, one decision, and most clients are making multiple decisions around just that particular aspect, around tax structures and tax, etc. We do a hell of a lot of work in that space, and that's where people can really get caught out, let alone the investments that they're set up in. I can't tell you the amount of times I've seen clients set up in the wrong tax structure with the wrong type of investments, poor investments that don't go anywhere over 10 years, not reviewed for 10 years, and all of a sudden you look back 10 years and you go, well, you probably just dusted 200 grand, that's, and you don't need a lot of money to do that, it can, $1 million, $2 million, whatever $1 million asset values, you can make a mistake and cost a lot of money.
Yeah. Yeah, 100%. So there's the one bad decision, which, by the way, is hard to tell someone when they're inquiring about advice. You go, well, and they say, is it worth it, or what's the value?
Yeah.
So, well, if you don't get advice, you might make a bad decision. People don't want to hear that.
Yeah, that's right. And I think advice is also about guidance, right? It's about just guidance and clarity. I think that's the part that's missed, and obviously hard to put a dollar figure on it, nearly impossible. But making the right decisions at the right times, in the right time frames, that's where a lot of value is for advice and financial advisors. And I think that's the part that gets missed.
Yeah, agree. All right. And so if someone can't, like, some people can't afford it, or maybe it's just not the right time for them to be paying an advisor.
Yeah.
So if they can't afford advice yet, but they think they might in the future, what should they be doing?
If they can't afford, look, I think it's still have a chat to an advisor. Like a good advisor, I just had a client meeting then where I said, look, now's not the right time to jump on board. But we agreed when that time frame might be down the track, and how much in money they needed to make it worthwhile. So a good advisor will steer that ship anyway. A good advisor won't take a client on board unless they can add the value at the right time. So I think it's okay to still engage and have a chat. We do that all the time, right? So understand when, with that discussion, when might be the right time to come on board, and maybe see if they can take some general steps themselves to start preparing for that. Maybe some allocating some surplus cash flow that they've got at the minute and on the side to start building up some wealth. But look, 9 times out of 10, we can generally add value from day one. It's pretty rare that we can't.
Yeah, I did. Like, it was interesting. Last year, I put out some TikTok videos on like paid parental leave and when you're having a baby and daycare fees and things like that. And I got inundated with mums, about to be mums.
Yeah.
So they all booked in phone calls, and then some of them booked in like the initial consultation and all that. But then babies started popping off left, right, and centre. I was getting emails saying, "Oh, sorry, I'm going into labour. Can we reschedule?" And so the timing thing's funny because you'd think you wouldn't want to sit down with an advisor at that point, but I have the baby that's sitting at home all day.
Yeah.
So I ended up having loads of meetings with people while they just had a fresh baby a few days old in the background.
Got some time on my hands.
Yeah, so it was like good timing for that, but on the cash flow side, probably not great timing because they're taking time off work.
Yeah.
So we're just like, we're flexible with that. Like we just did a base plan for them now.
Yep.
Didn't put them on the ongoing service costs and stuff while they're on leave, and everyone was happy. But
yeah, that's right. It's about like, you know, the right times, and absolutely, as you said, sometimes we do initial plan and then we don't need to do the ongoing management side of it. Sometimes we do the plan and we do the ongoing management side of it. So flexibility is key with finances because people's lives go up and down, and you know, finances in particular, it's a ride. So and we've got to adjust with the times. Yeah.
All right, let's move on. So next topic. All right, on I've got here, should young people avoid super? Okay, some quick numbers. So Amy is 27 years old. She earns 80 grand gross salary. Her super balance is $40,000. If she never makes any extra super contributions, she'll have about 900 grand at retirement age. If she salary sacrifices $200 a week into super, she'll have $1.7 million at retirement age. And that's pre-tax money. So the 200 a week will be 140 a week is how much her pay will reduce. Do you think Amy should do that or not? Is that money just locked up for way too long?
Oh, look, it's not a huge amount of money to make a huge impact for the future. So there can be great tax advantages to do that. Again, it sort of comes down to any short-term goals we need to cover off outside super, buying homes or the like, and that's obviously unpack that. But look, it's a no-brainer. If you invest for the long term, consistently, small amounts of money, you end up with a large pot of gold at the end of it, right? So, you know, it makes sense to stick a little bit in super. How much that is can vary year to year, depending on what's happening. And we can have those discussions as well. But look, the more you're in this world, especially in Australia, the more tax you realise you're paying, and the more frustrating it is how much tax you're paying. Where superannuation is clearly the best tax structure going around. And trust me, when you get to the 50s, you'll want that balance to be as high as possible. So I suspect, you know, it should come into every strategy. However, again, as I said, any short-term goals, we can factor that in.
Yeah, and so, like, to be honest, I wish I'd done more in my 20s.
Yeah.
Because it all got spent then anyway.
That's right.
I was just travelling and bloody snowboarding and going out and
Yeah.
working hard as well.
Yeah.
I was doing all that stuff. And when you're in your 20s, you just think, whatever, I'll live forever. That's something to worry about later.
Yeah, that's right.
And then, you hit 40 or something, and you go, oh, it would have been good to throw a little bit extra in back then before I had a mortgage and kids and all the other stuff.
Yeah.
So you can't, like, if you put more in your 20s, you won't regret it.
No.
Like, you're not going to get to 35 and be like, oh, I wish I hadn't put an extra $200 a week in 10 years ago.
No. I've never heard anyone regret it, especially once you do get a bigger balance in super. The earlier you get that bigger balance, the compounding effect is massive. And then it gives you a lot more options with your super too. So, you know, you get a big balance, 300, 400 grand. Well, that's when you can start buying, say, commercial property in super. So it just gives you more flexibility. So the sooner you sort of get that balance up, the more options you get.
Yeah, agreed. So I've got here case for, case against. So case for, obviously the low tax is massive, and it's the only low tax option we have pretty much. The money's invested, so it's compounding in a low tax environment. And then when you get to retirement, there's no capital gains tax or anything. It's forced saving. You put it in, you can't get it out, which is a con and a pro, definitely. The case against, obviously the big one is it's locked up. And, you know, if you go into the comments section of our social media pages, we're full of anonymous people saying, oh, I'll be dead by then. And you might think that in your 20s, but it's probably not the case. Case against opportunity cost. Like, you put the money in super, well, you could be doing something else with that. And then the other one is, government intervention. You know, it's low tax for now, but obviously the amount of money in super, what is it, $4 trillion? Like, a future government is probably going to look at that and try and figure out if they can extract a bit more. but we can only play with the rules as they stand. Right? We don't know what the future holds. So.
No, that's right. Look, that is probably the one that concerns most people is the changing rules. I suspect even this latest Albanese government has sort of hinted at tapping on the superannuation system to build Australia effectively. But look, as you said, you can't predict the future. Rules are going to change. It's going to change. So we can only move what we've got at the minute. I get those concerns. And that's why we don't stick it all in super. We have a balanced approach to doing some in, some out, some spread and diversified different structures. And that's key.
Okay. And does the advice change if someone owns a business or starts a business and let's say they're not paying themselves a big salary, would you still say try and get more money into super?
That's a tricky one because business owners need cash outside super, because if something goes wrong with the business or you need to expand the business or whatever it may be, end of the day, the business owner is the one that's liable to do that. So it's tricky. So it really depends on the circumstances of the business owner, how much free cash flow they've got, what is the business doing, where they want to go, etc. So that work as a business owner's less of a stable income sometimes because fluctuations of income come into picture. So being a business owner myself, it's tricky. You've got to make sure you've got all other bases covered as well. Because at the end of the day, your business is, in a lot of respects, you're sort of super long-term business. And I see this business as probably my long-term super as well. So it does vary with business owners. That's probably a carrot to it all.
All right, well, let's jump to that topic then.
Yeah.
That's one of my other topics here. And I've heard this. I used to hear this a lot. It's less common now. I think people are a little bit more savvy about super than they used to be. But I used to hear this a lot. My business is my super.
Yep.
Like you try and talk to a potential client about super, and they say, I've got my business. I don't care about that.
Yeah. Yeah.
But I've seen it go wrong a lot.
Yeah. Yes.
So, so here's a stat. 27% of self-employed Australians aged 60 to 64 have more than 100 grand in super. It's bugger all, right?
Not much.
At 60, of 100 grand or less is nothing. So, hard question first. You own a business. Is your business your super?
That's a very good point, Billy.
You don't have to tell me your super balance.
Yeah, look, I'll be honest with you. I definitely have superannuation. I own a wage here and that pays super. So mine's definitely going north. It's not probably the size of it should be, given my history. But yeah, I look at it this way. You want to have both worlds work. Absolutely. Both those worlds. So business world going up in value, superannuation going up in value, have both of those driving. As you said, you don't want to rely on one new business to be your super. You need that as your bonus check, call it that, really for the future. You want to definitely be focused on your super as well. And the reason is it's not just about that aspect. It's also getting it into super is tough, right? There's a lot of rules and contribution caps of getting money into super. So you want to get it in over the journey rather than at the last minute, right? And on top of that, it's earning very good money in super fund and not paying much tax at all. So you want both worlds working for you. And as a business owner, there's a range of tax concessions you get with superannuation that you can also look at when you do sell, which can be very favourable.
Yeah, and this is like, if I think about where I've seen it go wrong, if you think about what sort of businesses and industries were thriving and common 20, 30, 40 years ago and where they're at today, and here's some examples like retail, like bookshops, news agencies, independent pharmacies, like Chemist Warehouse went after those. Taxi some people had a taxi license, which was what were they, like $1 million or something?
Yeah, God, there was $1 million.
And then they're worthless.
Yeah.
Farming, obviously always under pressure, like dairy farmers, things like that. And manufacturing used to be a big part of our economy. Now it's like, yeah. So all those if you go back 30 years, people with those businesses were like, yeah, I've just got my business. It's my future. It's making good money.
Yeah.
If they reinvested everything in their business all the way to recently, like you can end up with bugger all.
That's right.
That's where I've seen it go wrong.
Yep.
It's like you feel like, well, everything's going well, so I'll just reinvest in the business. So I don't need anything else.
No.
It can change.
That's right, can change real quick. And that's purely 101 of diversification, right?
Yeah.
Like you want to diversify. We talk about diversifying in assets and investments, etc. But you want to diversify your wealth portfolio as well. Like, don't all have it all in property. You've got to have property and managed funds and everything else. Don't have all of it in business. You want to have business, super, main residence, other property, investment properties, etc. So diversification is a word thrown around a lot, but it means exactly that. And people need to diversify because no one really knows what's going on.
It's not always under your control.
No, it's not.
And even in the bit like this business, without going into details, like we diversify, you can diversify within your business.
Yeah, that's right. Like we used to have just one revenue stream with advice. We went out of our way to create multiple businesses so that we could diversify the risk. And now we've got an accounting business, a finance business, an offshore business, the wealth business, because no one really knows what 10 years looks like. We can still predict it the best we can, but we've done that on purpose to build wealth in all those buckets so that if there is a lever that's pulled on one of them and it changes the landscape, well, we've got another 3 or 4 to back us up. And we'll continue to do that. Whether we have 4, 5, 6 businesses, we'll probably keep on doing it for that reason.
Yeah, absolutely. Diversification, it's probably an overused term, but it's the whole game.
It's the whole game. It really is.
Not just within a business, like in life, like just diversifying.
Yeah.
Don't put all your eggs in one basket on one thing, because you only get one chance.
100%.
And I think I spoke about it last week. Like even if you don't plan to retire, you might be forced to, and you might still be around for a long time.
Yep, that's right. Yep. Yeah, think long term, de-risk. It is about managing risk, and also, they change the rules. We've seen the government change the rules recently with self-managed super funds buying residential property. Well, I know a lot of buyers agents out there that were just doing residential property and self-managed super funds. Overnight, probably not even overnight, it was like 12 hours. We found out, right? All of a sudden, their businesses hoofed. So now they're going, shit, we're going to find another revenue stream, right? So they should have thought about that a couple of years ago and gone, right, if they change the rules here, I'm in trouble.
Okay, so on SMSFs, the government banned, what do they ban?
Taking a loan to purchase residential property, effectively. What they banned.
So they didn't touch commercial property?
Didn't touch commercial.
Yeah.
No, so that's interesting.
Why didn't they touch commercial?
That's a very good point.
Because they went after everything else.
Look, I think predominantly the narrative is to try and take the heat out of the residential market, right? So they want to house prices, first home buyers, etc. That's all in the media. How do we get more people buying their own home? They figured they would try to limit SMSFs buying residential property to try and assist that. Don't think that's going to work, to be frank, but that's really the reason why they've done it. So people aren't going to live in a commercial property, so not really part of the picture. So they've still allowed that. That's the nuts and bolts of it. Okay,
so commercial property, warehouses, offices, factories, retail shops, all that stuff, right? Anything except for a house, pretty much. Now, this is interesting, and not everyone knows this. If you own a business and the business needs a premises, you can set up your own self-managed super fund or do it with a few other people. You can buy a business premises and your business can lease the property. So let's start with why would someone want to do this? Like, what are the benefits?
Well, the benefit is you obviously get a good asset in your super fund for your long-term wealth generation. That's a benefit. You operate your own business within that commercial property. So you're the landlord and the tenant. So you obviously got to look after it because you own it. So that's good. So that's really, it really gives people the ability to buy their own office effectively, or factory, or garage in their super fund in a tax effective manner, and build wealth at the same time. So it's a very good strategy, that one, and one that we've done a number of times for a lot of clients.
And then you get to be your own landlord, so you don't have to deal with bloody estate agents or
100%
third parties, or you can do whatever you want to your building. And
and if you're going to be there,
don't have to hit yourself with gigantic rent hikes out of nowhere.
No, that's right. Yeah, if you're going to be there for a long time, it makes sense. So it's very common for factories. We've done a number of mechanics, etc.
Okay, should everyone do it? And anyone who has a business, should everyone do it?
Well, it depends on the value. If you're operating in a premises that's unbelievably expensive, probably not. Or if you want to move, maybe not. It does come down to personal circumstances, but I think it's a very good strategy to build wealth, build your own wealth for the future. And you've got to remember, we can sell that asset down the track tax free.
Yeah, it's massive.
Once you hit a certain age, so that's a very favourable position.
Agreed. So they're the benefits, the risks. Well, I mean, so your super fund, you're investing for your retirement. So you're selling it to pick a good asset.
Yeah,
that's probably the thing. Like if you've got a small business with a small premises, you got to look at it and say, well, is this asset going to grow? Because the other options are share markets and other things.
Yeah.
It needs to be a good asset. And then we spoke before about businesses that over time might face headwinds and trouble. And with commercial property, a big risk is having to get a new tenant.
Yep.
Can take ages. Yep. Might spend money on fit outs and things like that.
Yeah, absolutely. So, the vacancy rates can be a lot higher with commercial property. So if you're not going to be the tenant, maybe consider that because that is a risk. And all of a sudden you've got this asset in there that's not got any money coming in. That can burn itself in a super fund real quick. So you've got to be very careful on what, end of the day, it doesn't matter what asset you're buying, whether it's just buying it for your own office, etc. You want to always buy good assets. So don't just buy something for the sake of buying something. I had a conversation with a client then, we're talking about selling one of his properties in the SMSF fund because it's just not moving. Yeah. And so it's important. It doesn't matter what it is, buying good assets is 101.
Yeah, and we're seeing like a lot of people who, with self-managed funds, you can go to an advisor and pay. We've spoken about cost of paying for advice. Or a lot of people just do it all themselves. And the DIYers, we've seen so many times, they do an SMSF, they buy a property and they have nothing else in there.
Yeah.
And it's like, there's just no buffer. There's no diversification, no buffer.
Yeah.
And you don't want to do that with a commercial property.
No.
So if you lose a tenant, you're going to have to find some cash quickly.
Yeah, that can really get the self-managed fund in trouble where you default and all this other stuff happens. And it's nasty.
Yeah, and then borrowing can be a bit complex as well.
Yeah, different. The way the borrowing works, the banks will look at it a bit differently. They'll look at the commercial property, what the contributions are coming in, what the rental return is going to be. But it is a different type of lending, and the banks will look at that differently.
Yeah. All right. Cool. So it's SMSFs. Last topic here is rent vesting debt. Like, because we've done a fair bit of content and scenarios. We've helped clients with it over the years with the rent vesting strategy.
Yeah.
But these tax changes, have they killed that strategy altogether?
Oh, I don't think so. I think rent vesting is still a very good way to live in a location that is that you probably couldn't afford, and then buy other properties to build wealth. So I don't think so. I think it's still a good strategy. Yeah, these changes to the property landscape have adjusted how that looks and feels. But I think rent vesting is still a very good way to build wealth for the future, especially if you've got your heart set on a certain location you want to live in, and that location is very expensive or wherever it may be. So, I know some of the inner city suburbs of Melbourne that some of our staff live in, they're not cheap.
Yeah, I'm doing it.
Yeah, she's doing it. I'm doing it. So I probably couldn't afford to buy what I'm living in, but the rent's quite low. I think it's a yield of 2.5%. So, I'd rather pay the 2.5% on that than go spend millions and millions of dollars and have X amount owed to the bank.
Yeah, and so rent vesting it's just investing. You don't have to actually buy other proproperties.
No.
Like you can buy a business.
Yeah.
Shares.
Yeah. Absolutely. Yeah, you can use absolutely. I think you've done that.
You just go, well, I want to live in this nice suburb.
Yeah.
I aspire to buy a home here one day.
Yeah.
And this is how I'm going to do it. I'm going to move there right now, rent where I want to be, send the kids to a nice school there, and then just invest, and I'll be able to buy a house later.
Yeah. And maybe you just will build wealth outside property anyway. Who knows, right? I think property as an investment in general, I think there's a lot to be said for it being not that great sometimes. Maintenance of house, upkeep, rates, insurances, etc. It can be quite painful where you can then build wealth in businesses that you control, that you work in, or manage funds or whatever it may be. But there's lots of pros and cons to that scenario.
Yes, and so if we think about people who still want to look at rent vesting in terms of like just buying an investment property, like the classic strategy, the way you used to do it was, you rent where you want to live.
Yep.
You buy an investment property anywhere else that you can afford, where you think there's going to be a good capital growth. You might put down a 10% deposit, borrow the rest, get the negative gearing benefits. That helps with the cash flow along the way. Then down the track, you hopefully sell at a big profit and you might buy a home then. That was the strategy. Negative gearing's gone. It has a huge impact on borrowing capacity and cash flow. So if you wanted to try and do this strategy now, would that change, what sort of property you buy or the mechanics of it?
Yeah, well, it definitely has changed what you're looking for. It comes down to what your tax rates are and what your marginal tax rates, and the cost-based scenario that they're using now for the negative gearing, so you can only offset the negative to the rental income effectively. You can't offset against other losses, but there's a range of variables that go into this, and it really does depend on the individual circumstances now, because it's still there. It's just we need to really understand from an individual point of view what that looks like, what's the type of property you want to buy, what's the rental yield's going to come in, how those figures sort of pan out. Are there other incomes coming to play? What do we have existing properties still there that are grandfathered in some way, shape or form? So it's now become, it's not, you've really got to dig under the cover of really individual circumstances to work this out. But I agree. There's the positives of this scenario has definitely got less. That's for sure.
It's less, yeah. You do it if you're really prioritizing lifestyle, probably. Or you've invested in a business owner or something like that. But there's even the property type. Like I know some of the buyers agents we speak to, they're saying, well, yield's more important now. Because capital gains are going to be taxed at a higher rate. You don't have negative gearing, so you really need rent to cover more of the costs. So you can still do it. It's probably a bit riskier because you're probably looking at lower value properties.
Yeah, that's right.
A huge shortfall on the cash flow.
But also, like at the end of the day, you want to buy investments that make you money. So negative gearing should be secondary to conversation, right?
You're losing money. You're just hoping you'll make a gain in the future.
So we want to make 5 properties that are making money, right? And so that's the critical part. But finding those properties, is harder, right? Because the interest rates are up, yields aren't that great across the board. So it's harder to find those properties, but really that's where it's important to find the right property.
Well, I could just buy off the plan. You get negative gearing if you buy new.
Yeah, you buy new if you get negative gearing, but then there's a huge risk, right? Because God, we've seen so many horror stories buying off the plan.
Yeah, a lot.
I couldn't probably suggest people do it because it's so risky. You buy the wrong property and it just goes negative 50 grand overnight sometimes.
Or it takes 3 years to build.
Yeah. Or they go bankrupt and you got nothing.
I've got the question here. Maybe we've answered it. At what point does renting where you live stop being a smart trade-off and start just becoming a trap?
Oh, look, if your rent's, I suppose, really high, it goes really right up, that probably counts it out a bit. Or if property values drop in that area and becomes quite appealing to buy, well, you look at buying.
Just go for it.
Go for it. Yeah, so a couple of variables there. Generally, those areas don't fall in value too much if you're in a nice spot, but there's a couple of variables, but if my rents went up astronomically, that probably wouldn't make sense. Yeah,
and with all this tax stuff, super's low tax. The only other thing is a family home, tax-free, right, a PPR. So, if you can do it, sometimes you should just go for it rather than say getting stuck in, I need to rent vest or I need...
Yeah, that's right. Yeah, look, you're 100% right. The family home's still tax-free and hopefully they don't change that one. But that's a great tax vehicle if you can buy a home and then down the track sell it. You're not paying any tax on that capital gain, which can be very good.
Awesome. All right, I think we're wrapping up. Anything else, Steve, to add?
No, look, I'd say back to point one about getting advice. This is where really advisors can assist, right? Our job is to work out the individual circumstances, what those goals are, and really deck out that plan, because right now there's a lot of variables out there to deal with, and the best people to deal with those are the advisors.
That's it. That's a good spot to end it. If you've got something out of today, please give us a follow, review an episode, or share with a friend, family member, or colleague, and vote for all four of us, or maybe just me. In the financial standard Power 50.
Yeah. Yeah. No, it's good to see us all get a spot on the board.
Yeah, awesome. So thanks, Steve, for joining us, and we'll see you next time on the Winners Playbook.
Thanks, Billy. Cheers.
Thanks for listening to the Winners Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.